Could you please explain the concept behind book to price? It's actually price to book, but that's okay. And how to use it in a practical way. I certainly can. I was just reading Fundamental Analysis, a person who had a thesis on Citibank. He said that, Citibank in comparison to its peers, right? So in fundamental analysis, we're looking at an attractive valuation. We want to have a margin of safety. And he said the Bank of America and JP Morgan are trading at 1.2 times book in the market. 1.2. So these are companies whose market values are higher than their book values. Book value represents the theoretical liquidation value of the corporation. We don't assume we're going to liquidate the corporation. But if we sold off all the assets, we paid off all the liabilities, remember the shareholders have a residual claim. And then he said Citibank is trading at 60% price to book. Wow. It's trading for less. Its market value is less than its book value. Wow. And he was saying, if the CEO, if she's successful, and he said she doesn't have to be successful to get to 1.2, but if she can just get the market price to be 80% of book, that would be a decent return. And so that's why we're using price to book. We're using it as a valuation, as a margin of safety when comparing the investments. By the way, remember, we're comparing this investment, either the economy, then the industry, in this case, banking. Banks trade pretty close to book. And then the particular stock within that category. Now, that also means she should be aware. I don't know how many people have the resources to gobble up Citibank, but it also means that, if I were like Ken Griffin at Citadel, I could make a tender offer and maybe I try and take Citigroup public or private at 80% of book. So I would say the practical way we use price to book is a margin of safety in terms of valuation. Right? Usually it would be not can you crunch book value, but do you have this understanding of this price to book is the, a value proposition. Brian, your thoughts on that?
Yeah, that's exactly right. It's another fundamental analysis tool to determine the value of the corporation. Exactly what Dean said. All of these ratios we see on the Series 66 is for analysis to find out the strength and or weaknesses of a company before we invest in it and put it in our customers' portfolios. And that's kind of the theory behind the Series 66 is that we're building portfolios, structured portfolios for clients, and we want to analyze these corporations, whether it be price to book, whether it be current ratios or quick ratios, or any of these ratios to determine the strength, the liquidity values, and debt to equity. How leveraged are these companies before we invest in them? That's what it's all about. It's all about fundamental analysis.
Yeah, I would just again say too, like valuations would be also, remember, using the dividend discount model, the PE multiple. These are all those valuations. Now, we don't care about that in a growth situation. Like, who gives a damn about NVIDIA's book value, right? Nobody, because they don't have any physical assets, so to speak, right? So, different industries get priced differently. So that would be the other thing I would add to that.